TCS numbers. That should be flashed for you just on the screen. A quick run through of the expectations. We are working with the dollar revenue growth of 1.2%, a constant currency growth of 1.7 to 2%, with margins coming in at 26.7%. The bottom line is coming at 8,110 crore, which is in line with expectations. So that would mean a growth, that would be a bit of a growth on a quarter-on-quarter basis. So that's on the bottom line. 8,101 crore is what the company's delivered by way of the bottom line. We'll just wait for that to get flashed on the screen. This would imply it is a growth of close to about 2.6%. It's largely in line with expectations on the bottom line. Sorry, there has been a correction, 8,105. So just slightly lower than our expectations. So it misses our expectations by 80 to 90 crore, but that's on account of the rupee movement. The key to track will be the rupee revenue. Rupee revenue has come in at 37,338 crores. So that too falls short of our expectations by close to about 400 odd crores. So the top line too has missed our estimates marginally. EBIT is coming at 9,564. That is actually significantly lower than expectations. So 9,564 would imply margins of close to about 25.6%, which means a decline of 90 basis points on a quarter-on-quarter basis. The street was actually working with flat margins. Compared to that, the margins have come down by 90 basis points. You know, a little bit of a decline in margins would have been acceptable considering there is a large element of a cross-currency headwind, which would have hurt the company's bottom line. But even that apart, I think the margins would have come in lower than expectations. Constant currency growth has come in at 1.8%, and this is bang in line with expectations. So a quick run through on the numbers. Constant currency revenue growth of 1.8% in line with expectations. This would imply that growth has slowed down compared to the prior quarter on account of seasonality. This is a seasonally weak quarter because of year-end furloughs, but a 1.8% growth this quarter would fare better compared to what the company did in the December quarter of last year, which was a 1.3% growth, which gives you a sense of the accelerating momentum. However, on the other hand, the margins at 25.6% is a decline of 90 basis points on a sequential basis. Again, it would be hurt on account of cross-currency, but still lower than expectations, and that is driving a minor miss in the company's profitability as well. We are also getting the digital revenues on your screen. Digital revenue contribution to the top line is coming at 30.1%, which compares with 28% in the prior quarter. So digital continues to accelerate. I'll hand it over to my colleague Kritika, who's at the TCS house. Let me try and get if she has some more information. Kritika?
Well, Reema, okay, I'll just take you through the headline numbers. I think you have all the headline numbers already, but just running through it very quickly. In IFRS dollar terms, 5,250 crores in revenue terms. So on constant currency basis on a year-on-year, 12.1%, and you had the Q-on-Q figure as well. Margins, as you were pointing out, had come in at 25.6%. I've just gotten the exact breakup in terms of the fine print as well. So this time around, the number of 100 million customers has gone up by about 8 points. In terms of the digital revenue, they say that on a year-on-year basis, they've actually seen digital growth up by 52.7% on a year-on-year basis. If you break it up in terms of, again, we just have the year-on-year performance. The growth in UK has come in at 25.1%. The growth in Europe is coming at about 17.6%. You had the constant currency figure, that's 1.8% of growth Q-on-Q basis. In terms of the breakup, again, BFSI growth has seen acceleration 8.6% year-on-year. UK and Europe, I just pointed that out. They say that they have seen a continued investment in organic talent development, industry-leading talent retention, IT services attrition at about 11.2%. So that's a broad breakup. I'll go into the retail breakup as well now. The revenue breakup by industries and by markets as well. So I talked about BFSI, that's about 8.6% on a year-on-year basis. Energy utilities, 18.1%.
Kritika?
Life sciences and health.
Sorry to interrupt. Do you have the dollar revenue number with you?
Yes, Reema, we have the dollar revenue number with us. That's $5,250 million in Q3, up by 9.7% year on year.
Okay. Go ahead. You were telling us about the other details as well.
Yeah, so I'm just going to quickly run through the exact breakup. Reema will be able to help you with the exact Q-on-Q figures. We have the year-on-year figures in the press release. So life sciences 15.7%, communication and media 10.8%, and retail and CPG 10.5%. If I further break up the revenues by markets, I'm trying to look at US. Okay, so UK, Europe, Asia Pacific led growth. North America grew by 8.2%, and India grew by about 9.7%. Again, this is a year-on-year comparison. India is typically sluggish, so I wouldn't expect much of a growth on a Q-on-Q basis. Latin America saw about a 7.6% growth. I have about 3 different papers with me. I'm trying to figure out the volume growth, but quickly let me also talk about the dividend. They have announced a dividend per share of 4 rupees. And this was something that we were also expecting. I'm just quickly reading out the statements from the management before I toss it back to Reema. The CEO of the company says that we are wrapping up 2018 on a strong revenue growth of 12.1% in December quarter, which is the highest in 14 quarters. The strong client metrics, industry-leading growth in digital services, and a strong order book and deal pipeline are all validation that customers recognize our differentiated capabilities and are picking up for the growth and transformation projects. No cautionary points here, but he did say that on a secular basis, as large segments of the economy continue to go through a churn driven by digital, they are creating opportunities for us, and the investments seem to be paying off. So yes, there is a little bit of caution on the headwinds from the CFO. The CFO of the company says that despite headwinds from the rupee volatility against various currency, higher cost of doing business in some major markets, operating margins have been resilient. So it seems like they seem to be, again, sticking within that margin guidance range that they had been pointing out, Reema, but we should have more fine print from the management. I'll toss it back to you to talk to our guests, and as and when I have more fine print, I'll come back.
Okay, thank you very much. Well, they've been holding on to their margin guidance band of 26 to 28%, even when the margins had gone down to as low as 23.5%. But let's invite our experts to make sense of the numbers. Milan Desai of IIFL is here with us. Milan, net, there are no positive surprises. Constant currency growth has come in at 1.8%, which is in line. The digital revenue growth has been strong, 52.7%, which is slightly lower than what they had in the prior quarter, which was a 60% growth. So digital continues to keep up pace. There is an acceleration in BFSI, so that's happened for the second consecutive quarter. 8.6% growth on a year-on-year basis versus 6.1%. But these are largely, I guess, already expected by the street. There is a bit of a miss which has come in on the margin front. So net, how would you read the numbers?
Yeah, so basically on the dollar revenue front, it's actually in line with our numbers. We were slightly over the 5,250 mark in US dollar revenue. So we are set over there, and the constant currency growth also is largely in line with our expectation. But margin is something that we see that there is a miss, and probably this is slightly because of other SG&A expenses going up a little bit. How much
the cross-currency headwind
margin we need to see?
Actually, the cross-currency headwind on the top line itself is 110 basis points, because the company's reported 1.8% constant currency growth, while the dollar revenue growth has come in at 0.7%, which means the cross-currency headwind on the top line itself is 110 basis points, which I guess is eating into the company's margins as well, Milan.
Yes. Further, just on the margin side, any particular details that we can get, that would be worth looking for.
Okay, Milind, would you be concerned about margins coming in at 25.6%? You know, there has been an aspirational band, yes, that was between 26 to 28%. What range would you give it? Would you expect it to come in by the end of next fiscal or by the end of this calendar year? What timeline range would you give this?
So, based on our estimates and looking at what we have right now, we were expecting, say, about 50 bips drop in the next quarter. Again, that we'll have to relook and see how much adjustment happens, and then probably bring it down for FY19.
Okay, a quick question to Ritesh as well. Ritesh, with respect to the digital growth, as Reema was pointing out, 52.7% on a year-on-year basis. This is in line with some expectations and in perhaps below some expectations. So, Hitesh, what do you make of the kind of incremental revenue growth that they've been seeing from digital? And do you believe that the order book that they had seen in the last 3 quarters will offset any currency headwinds or any operational headwinds that they may see in Q4 as well?
Dipesh, this question is for you.
Yeah, sorry, I missed the question. Can you repeat?
Dipesh, what I wanted to understand from you is, do you believe that the order book that TCS has had so far will be able to offset the kind of headwinds that they are expecting to see in Q4 as well? And would you be concerned about the digital growth? Incrementally, it is slightly below what some expectations had outlined.
So I think their order intake remained robust for last few quarters, and I think numbers are also, if you look from constant currency YY, seems to reflect continued momentum. From number, I think disappointing part remains on the margin, but I think also if I look from constant currency hit and other thing, I think broadly they remain within the guided range. So how I would look overall number, I think broadly inline kind of thing, bearing margin where they have seen some slight miss, but otherwise I think broadly inline number.
Okay, broadly in line according to SBI Caps. We also have Sanjeev Hota of Sharekhan joining in. Sanjeev, when the stock is put in this kind of an outperformance, it's rallied 40% in the last 1 year. It's outperformed the Nifty IT. It's still the most expensive IT company trading, at least in the tier 1, trading at 16 and a half times FY20 PE. Can any miss be tolerated? How do you expect the stock to react tomorrow?
Yeah, definitely this quarter performance is softer than what we have anticipated. Though top line was 1.8% broadly with the estimate, the margin performance is not up to the mark. So I believe that stock could react negatively in trade tomorrow, given that the kind of performance they have delivered. But I believe still the TCS remain one of the most promising stock among the top tier IT companies, the kind of growth visibility and the strong order book they had. So it's among the top promising company among the top tier IT companies.
Okay. Would there be any change in your EPS estimate, Sanjeev?
Yeah, we need more clarity on the margin side because management has also commented the cost of doing business in US is going up. So what need more clarity on that, and how much the margins is from the currency impact and how much from the cost of doing business in the US. Need more clarity on that. After that, we will take a call on the margins. But looking at the margin performance this quarter, there could be some kind of tinkering need to be happen on the estimate going forward.
Milind, a very quick point from you with respect to the macro issues that are there at this point in time. UK seems to have performed and Europe has been performing, and that seems to have been the trend over the last couple of quarters. But would you expect headwinds in UK and Europe to affect them? And what's the general sense that you're picking up with respect to deal pipeline in US? Again, in this quarter, no major surprises coming in from US as well.
Yeah, so even if you follow the commentary across the... Yeah, can you hear me?
Yeah, go ahead, Milind.
So basically, if you follow the commentary across the news and from the industries interactions, yes, there is a slight bit of curtailment in terms of growth expectations, but if the client interactions have suggested from the companies that they do not face any issues per se from America. The ordering is up, although the deal sizes are getting smaller, but the ordering is moving up and is likely to move up. Although there might be all in all, if you look at the overall spend impact on the overall IT spend, yeah, there might be some impact with a lag, but we do not expect it to be significant.
Okay, we are expecting the management shortly, so we should have them answer more questions about what lies ahead. But last question from me to Dipesh before I toss it across to Reema. Dipesh, where do you think TCS stands versus the rest of its peers? You saw Accenture's performance. Accenture has clearly pointed out that there will be volatility. From a purely comparative perspective with its immediate peers, where do you think TCS stands? Are they still on a strong footing, irrespective of the possibility that Q4 may be incrementally lesser than the first half of the calendar year?
So if I look from revenue performance, even this quarter, performance remain broadly in line with expectation and remain very healthy. Even if you compare with, and it is among top-notch kind of performance, so they continue to deliver top quartile performance. Margin is the area where they have disappointed to the expectation kind of thing. I think better clarity on that part may address some of the concerns prima facie comes emerging from this quarter's performance so far. So I think margin is the area where people require more explanation. I think revenue broadly what people were expecting from the TCS kind of thing.
Okay, just a quick run through of the people who've tuned in late. TCS has announced its numbers. There are no positive surprises. If anything, it has missed on the margin front. So run you through the positives. Constant currency growth at 1.8% QOQ in line with estimates. On a year-on-year basis, it's come in at 12.1%, which is at a 14-quarter high. So that is a positive, which means the company is definitely on track to end the year with a double-digit growth, which is what the company's guidance has been. BFSI growth rates continue to accelerate. So this quarter, it's come in at 8.6% year-on-year, which compares with 6.1% in the prior quarter and 4.1% in the June quarter. So that trend continues to, BFSI continues to accelerate, even though as of now, the growth rate is below the company average. And digital continues to see strong growth rates, more than 30% contribution to the top line. It's seen a growth of about 52% on a year-on-year basis. The miss has actually come in on the margin front. It's missed our estimates by more than 100 basis points, coming in at 25.6% lower than the company's guided band. And they've highlighted two factors. One, of course, is the currency movement that we know. But secondly, they've also, reiterated the fact that it's on account of a higher cost of doing business. And this is something companies like Persistent and Hexaware had also flagged off in the September quarter. The demand fulfillment is becoming a challenge, especially on-site, on account of a talent crunch and the tighter visa regulations. So that the higher cost of doing business is eating into the company's margins. And this is the first time the company has articulated this. And this comes at a time when the rupee has actually reversed courses. So up until December, it was depreciating. But since December, in this quarter, it's actually started appreciating. The average for the rupee in the December quarter was closer to 72. And now we're closer to that 70 mark. So rupee, which was a tailwind up until now, is going to become a headwind. And now you have the company also talking about a higher cost of doing business, which is eating into the margins, which means when TCS, the largest company, talks about it, this is going to be a factor to worry in the coming years, not just for the company, but for the industry as well, because even other smaller companies had spoken about it. But when TCS faces that problem, it could be, a bigger industry problem that we need to reckon with. So that is the big negative on the margin front on account of currency as well as the higher cost of doing business. But on the positive front, they continue to grow quite well, and they're quite, 12.1% on a year-on-year basis, highest in 14 quarters, gives you a sense of the kind of momentum the company is enjoying. Moshe Khatri is also here with us. Moshe, your read through of the numbers?
From a big picture perspective, I think the main thing here is that the numbers were better than feared. That's how I kind of look at it. Remember, we've had some incredibly volatile macro environments starting in September, ending in December. And one of the biggest fears was that we were going to see some sort of an impact on spending patterns, and we have not seen that. That's a big deal. That's probably should be the biggest headline here. We actually released our spending survey a couple of days ago, and it kind of told us kind of the same thing. The buyer has been resilient. That should probably be the number one headline here. The margin miss that we've seen is a function of investments. All these companies in the space have been reinventing themselves, and they have to reinvest in their business, whether it's digital, whether it's shifting their delivery capabilities on-site, etc.
Okay.
So that, I don't know if that's a big surprise, but again...
Okay, Moshe, sorry to interrupt you, but Rajesh Gopinathan, the CEO, is speaking, so let's cut across.
For Q3, we have had a fairly strong quarter in a seasonally weak set of period. We're ending the quarter with a revenue of 37,300 odd crores, and in dollar terms, that's $5.25 billion in revenue. Importantly, it's the growth on a constant currency terms is 12.1% on a year-on-year basis, and in dollar terms, we now have closed calendar year 18 with $20.5 billion of revenue for the calendar year, and that's a growth of 10.3% in dollar terms from calendar year 17 to calendar year 18. Overall, the rupee growth is at 20%, aided by currency benefits, and for the quarter, the year-on-year growth for Q3 to Q3 is at 9.7%. The growth has come with a good margin defense. We are ending at 25.6% for the quarter, and on a year-on-year basis, that's an increase of 44 basis points, and growth in terms of the annual operating profit growth of 22.9%. We are on target to improve our full year margins on a 9-month to 9-month basis. This is an improvement of 118 basis points at an operating profit margin level. Coming on to net profits, we have crossed another big milestone in our journey, crossing 8,000 crores of quarterly net profit this quarter, ending with 8,100 crores of net profit, which is a growth of 21.7%. Rather, it's a margin of 21.7%, and translates at an EPS level to a growth of 26% for the full year, for the year-to-year basis. Similarly, we are quite happy with the cash conversion. We generated 8,600 crores of operating cash from operations this quarter, which is a cash conversion of about 107%. We are ending the quarter with 43,800 crores of cash and investable surplus. So overall, a fairly strong set of financial performance, and it is coming on the base of very strong business growth. I'll touch upon parts of that. Firstly, from a customer portfolio perspective, we have seen expansion across all customer portfolio levels. We have now added one more customer in the $100 million plus range from a quarterly basis, and on an annual basis, we have added 8 customers. So we've gone from 37 customers to 45 customers in this band of 100 million plus. From services perspective, digital continues to power growth. We have now crossed 30% of revenue coming from digital, and it's growing at more than 50% year on year. From a segmental perspective, North America growth acceleration continues. North America year-on-year growth has now come in at 8.2%, and Europe and UK continue to do well, which is continuing a trend that has been there for the last few quarters. The growth from industry segment perspective, very encouragingly, BFSI continues to accelerate its growth trajectory. BFSI this quarter is at 8.6% year-on-year growth, with strong growth coming from North America, from insurance, and very broad-based growth across the insurance segment. And as I said, from North America, despite some impact in UK and Europe on the banking side of it. Retail, in a very seasonally weak quarter for retail continues to maintain its greater than 10% growth rate at 10.5% on a year-on-year basis. And other segments which have been showing good growth, like life sciences, healthcare, energy and utilities, all of them have continued to deliver well on the growth journey. So overall, a strong quarter, strong pipeline. Our order book for this, or rather the total contract values closed in this quarter, which is at $5.9 billion compared to $4.9 billion last quarter. So good order closure into this quarter, strong pipeline build-up also. And from a manpower perspective, our attrition continues to remain very low, industry-leading retention. And we added 6,800 new headcount, net headcount in this quarter, and totally 27,000 for the year. This compares to a net addition of about 7,000 last year. So very strong demand being serviced with a very strong addition on the headcount and on the capacity side. So overall, a strong quarter to wrap up the calendar year, and a strong pipeline and strong order flow that sets us up nicely going into the new calendar year. With that, I'll open it up for questions.
Thanks, Rajesh. The first question comes from Kritika Saxena from CNBC TV 18.
Hi, gentlemen. Happy New Year. Rajesh, as far as the overall deal pipeline is now concerned, we are beginning 2019. What's the sense that you are picking up? Because there seems to be some concerns with respect to macroeconomic stability, possibly impacting deal pipeline. So where do you see year-on-year deal pipeline? Is it likely to remain flattish, or could we see a marginal negative growth as well?
Kritika, from where we are, we see strong deal momentum. As I said, the order closure this quarter has been steadily increasing. It's grown almost 20% compared to last quarter. And on the pipeline front also, we are seeing steady build-up of it. But macroeconomic trends are something that are external, hard to predict. If something like that comes around, definitely it will have some impact on it. But right now, we are not seeing any impact into the medium term. And but as the year builds up, we'll have better commentary on it.
But is it the same as last year or slightly better in terms of the deal?
In fact, our deal pipeline adjusted for the one-off platform deals that we had, we are much better than where we were last year.
Okay. Some color, Rajesh, with respect to BFSI in North America. By when do you expect BFSI, the kind of pace that you used to see, by when can BFSI growth come or cross industry company growth average?
I would first let it come up to the company average. But say, if you look at it, it went from 4% to 7% to 8.6% this quarter. So it is steadily improving Q on Q. And especially in the North America sector, BFSI is doing quite well. In fact, North America BFSI has done well for us, and insurance overall has done quite well for us. So we're quite positive about the momentum that we see in BFSI. It's difficult to say when it will cross a certain threshold, but if it continues in its current journey, we will be exiting the year close to a double-digit kind of a growth rate. Okay. So that should be that would set us up nicely.
And how long would you expect the UK minor tremors in BFSI to continue?
Difficult to say. We'll have to wait and see. That market is right now a fairly complex market. So we are participating well, but difficult to say as to what the impact of that will be, given the short-term uncertainties in that market.
Okay, but very quick last question. Ramki, with respect to margins, can you break it up for us? And also, as you enter Q4, the kind of volatility that you're seeing, be it on-site costs or be it rupee appreciation, is increasing. So, A, do you stick to your margin guidance, and by when can you reach that level?
Okay.
And if NGS could give some more color with respect to the digital incremental growth, now that you've reached scale, could a quarter-on-quarter growth perhaps reduce in the next coming quarters?
Okay. On the margins, see, from a revenue perspective, we had a 1.8% constant currency growth. But on a rupee, it is 1.3. So obviously, the currency there has been an impact of 50 basis points on the revenue. See, dollar as a headline number, there has been some slight rupee depreciation. But across all the other currencies and a basket of currencies in which we operate, actually there has been an appreciation. So on an overall basis, there has been a sort of rupee appreciation from that perspective. So from a margins, obviously there is an impact from the overall at the revenue level. Also, we have added, as Rajesh said, close to 6,700 net in this particular quarter. And over the last 9 months, we have added almost 27,000, which is the entire full year, we were doing 7,000. If you look at the orders we booked, the growth which we are seeing in the various markets, as well as also in BFSI, etc. So we have been adding people. So the costs essentially in this quarter has primarily on the people cost, where we are seeing the growth opportunities and we are filling that. So that is where we are currently. On going forward basis, it's very difficult to predict on currency, obviously. So and currency depreciation is intrinsic to our business because the model really works on the principle that where it's an inflation difference between where we serve and from and where we serve from and where we serve our customers, that is really helped only by currency depreciation. So it's a mix of the cost and currency depreciation. So we will see how it goes. We are very much focused on our preferred range. There is no necessity to look away from it because if you look at all the parameters, 9 months, 12 months, our operating margin, net margin, everywhere we are higher than even our revenue growth. We are talking of 25% growth year on year. And even on a 9-month basis, our operating margin is 25.7. So absolutely no reason to look differently from where we have been. So we'll stay focused.
Okay, that is the TCS management sounding confident as always. Not as of now, at least, they're not seeing any reason, any macroeconomic issues which can impact them in the medium term. Net, it's a decent quarter by the company in a seasonally weak quarter. They managed to meet estimates on the revenue front. Margins have come in lower than estimates.